Hello and welcome to the Ditto educational series that will provide you with the skills you need to become a Forex trader. Today we are going to look at one of my favorite subjects, and that is support and resistance. I cannot stress enough how this is one of the most important subjects in Forex trading. Whether you are a beginner or an advanced trader, reading support and resistance correctly can possibly matter most in terms of ensuring you seeing opportunity for high probability trade setups in the Forex market. Support and resistance is possibly the most commonly used technical analysis tool amongst Forex traders. The concept is undoubtedly a widely discussed topic and closely monitored by traders, brokers, and speculators. When you are analyzing chart patterns, which are the wavy lines that our candlesticks form over time, you will start to notice that there are certain price levels that the market seems to respect, some more than others, but there is a clear indication that these barriers are unlikely or less likely to allow price to move through. At first, the explanation and idea behind support and resistance and identifying their levels may seem to be an easy one, but as most beginners discover, support and resistance can come in various forms and the subject is more difficult to master than it first appears. So, what creates support and resistance? Support is a price level where a downtrend can be expected to lose momentum, stop, and possibly reverse due to a concentration of demand in the market. As the price of a currency pair drops, demand can increase, and then a support line may begin to form. Alternatively, resistance levels can form due to a selling off when prices increase. Over time, areas or zones as they are sometimes known, and they are called this due to them not being exact specific prices in the market, support or resistance will be identified. These can provide valuable high probability potential trade entry or exit points that should be keenly observed. The reason for this is because, as a price reaches a point of support and resistance, it will do one of two things. It will either be immediately rejected away from the support or resistance level, or it will plow through the price level or zone and will continue in its direction or trend until it hits the next support or resistance level. Most trades taken by almost every type of trader in Forex are based on the belief that support and resistance zones will be respected and not be overrun. We have talked about risk management in a previous educational video, and perhaps now you are beginning to see how this may apply. Whether price is rejected by the support or resistance level, or there is a breakthrough, traders can use probability-based decision-making on the direction of the market price and can quickly determine if they are correct. If the price moves in the wrong direction according to your analysis, the position can be closed at a small loss. If the price moves in the right direction, however, the move may be substantial. We have previously discussed this in our risk-reward video, and I want you to think about how the two subjects interlink. So, what happens when our support or resistance is broken? When we see that price has not been respected and a valuable support or resistance level has been broken, traders may look to trade the continuation of a trend by entering on the retracement to the broken level. When price is broken through, usually there will be a short retracement before the continuation, and it's this level that traders may be inclined to place their trades, whether it's a buy or sell. Again, with trading probability and risk reward, we can place our stops at a reasonable position and look to take advantage of the market breakout. Be careful not to place your stop too closely, and don't assume you are seeing a breakout if you are using a very low time frame. False breakouts can occur just as often as actual ones. In summary, support and resistance levels and zones are one of the key concepts used by technical analysts and work in conjunction with a wide variety of technical analysis tools. The key properties of support and resistance consist of a support level, which can be thought of as the floor under trading prices, and a resistance level, which can be thought of as a ceiling. When prices drop and test the support level, the possible outcomes are the price will either lose momentum and the price will bounce back up, or the support level will be broken and the price will drop down through the support and likely continue to a lower support level. When we determine future levels of support, it can drastically improve our chances at entering high probability trades. Whether you are entering a trade or seeing that support level as a possible take profit or exit price, previous levels of support in the area give us a glimpse at a probable future that your strategies can be built on. These zones are areas where investors have high probability to buy. On the other end of the spectrum, foreseeing a level of resistance can be advantageous due to price levels or zones that could potentially stop and reverse market movement and hurt your buy positions. These zones are areas where investors have a high probability to sell. We are always looking to identify support and resistance based on historical data. Where price has previously been rejected, it is likely to again. The definition remains clear. Support and resistance prevents the price of a market pair from moving in a certain direction. They are not always respected, and some have greater significance than others. I hope you enjoyed today's video, ladies and gentlemen. Please open up your charts at home and contemplate what you have learned today. As always, contemplation is the key to learning. Thank you for watching the video. If you enjoyed our educational sessions, then please like and subscribe.